Qualcomm is an interesting semiconductor design company that holds large market share in the smartphone industry, but it's branching out into new industries and making great progress in automotive and personal computers. It's also branching out into the Internet of Things devices. And so far, it's having good success, especially in automotive and personal computers. So, investors are asking if this stock is a buying opportunity for 2026. I'll answer that question in this video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Qualcomm has demonstrated excellent revenue growth over the recent decade, and of course, during the pandemic, the company benefited, as did many electronic device sellers or many companies that operate in that industry that have their revenues correlated to sales of electronic devices, like Qualcomm. Of course, people staying at home and unable to travel, unable to go to concerts, unable to go out to eat. They spend a lot more money on electronic devices, and Qualcomm benefited as a result. And then you had the aftermath, the economic reopening, which caused its revenue to decline. But looking back over the decade, you can see nice growth from 23.6 billion up to 44.3 billion. Now, the market share gains in new categories will help grow the business and also diversify away from smartphones, where its customers are increasingly investing in their own proprietary technology and increasingly trying to go away from Qualcomm and the lucrative royalty revenue it gets for licensing its technology to companies like Apple and Samsung. But it's made good progress in personal computers, and it's made good progress in automotive, and I suspect those gains will continue, especially in automotive, where increasingly each car is embedded with more technology, and that will increasingly be the case as nearly every manufacturer is investing in driverless car technology in some form or another. All of that will be good news for Qualcomm looking ahead. The next thing I wanted to evaluate is the company's return on invested capital. As a semiconductor design company, which does not do manufacturing in-house and outsources it or generates licensing and royalty revenue, I expect good profitability and good margins, and I'm seeing that with Qualcomm. Its return on invested capital, if we exclude that year in 2018 where it dipped to negative 31% as an outlier, it's averaged about 20 to 25% in that time. But it's troubling that there's no real clear uptrend. There's a lot of volatility. And I suspect that will also continue, especially as the company transitions from smartphones into these other industries. The margins may not be as lucrative. The margin profile may be different. And so I expect some volatility, but I'd still expect the company to generate sufficient return on invested capital, which I categorize as an ROIC that's above the company's weighted average cost of capital, which at 14.9%, it is above the weighted average cost of capital, which I will share with you the calculation of that metric a little bit later. So I also wanted to look at the company's cash flow to sales ratio. And again, a lot of volatility here with this metric, as you would expect from a semiconductor company. The semiconductor industry overall is highly cyclical, and so you expect to see volatility from year to year, from cycles to cycles. And so on average, you can see the company generated roughly 25 to 30% in cash flow to sales, which is a solid figure. You would like to see an improving trend line there. You would like to see the peaks of the cycle be higher and higher in each subsequent peak. We don't really see that. You'd like to see the lows be higher and higher. We do see that, right? The 2018 low at 17.3%. It was better at the 2022 low at 20.6%. So that's a positive. So let's look at valuation for Qualcomm. The forward PE ratio at 14 and the forward price to OCF ratio at 13 looks attractive for a company with its profile. And by profile, I mean, revenue growth, cash flow, returns on invested capital, business model, the industry it operates, comprehensively considering the business. It looks attractive at these valuations. I also like to look at valuation using my proprietary discounted cash flow valuation model. And the intrinsic value per share I calculated for Qualcomm is $205. The current market price is $174. So even after applying a margin of safety of 5 to 10%, which I always do, the stock looks undervalued according to this metric as well. So I'm getting a similar answer on valuation when I look at the market multiples basis and when I look at my DCF basis. They both point to undervaluation. So to answer the question, do I think Qualcomm stock is a buying opportunity for long-term investors starting in 2026? I think yes. I think this is an attractive company to buy at current market prices. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.